I missed the joke earlier, but looking at the itinerary, you've got geopolitics, private markets, and India now. So I'm not sure who put this itinerary together, but you guys are gluttons for punishment. You're going to be following up with a view from Washington, D.C., so that might even be tougher. But I'll try to paint it with a positive brush. I myself am also a glutton for punishment. I've been managing emerging market active strategies for the past 20 plus years, and it hasn't been a fun run. Was trying to think about how to approach today, and it's always easier to kind of talk about things that are working. And I hope this afternoon is full of gold and artificial intelligence and really good momentum stories. But speaking about emerging markets, they started to work last year, and we saw some real pockets of opportunity. But I thought it'd be kind of tough to come in and say, buy Korea 150% up, or buy Brazil 55% up. We're trying to find some interesting kind of structural opportunities where we believe in the long-term fundamentals that were laggards last year, and we think with not really good reasons. So the opportunity that stands out within emerging markets is definitely India. But as a backdrop, just taking a step back for emerging markets as a whole. I was told there was a screen down here that's okay, so it's over here. So I won't be looking back at the slides and making sure I can refer to the right charts. Big picture, emerging markets has been such a tough place to be for the past 15 years or so. I think it's outperformed 2 out of the past 15 years compared to the S&P. That's been because of a strong dollar regime, US exceptionalism, emerging market countries continuously getting in their own way, COVID, China lockdowns, whatever it might be. There's been a lot of negative sentiment in the asset class. And that kind of led to a lot of home bias, at least for US investors, developed market investors as a whole. And you can see that chart on the bottom right. EM outperformance compared to developed markets tends to happen in cycles, long cycles, 7 to 12-year periods. And I believe we're coming out of a very long negative cycle. And coming into this year, we ran a survey amongst US financial advisors. The average US financial advisor had a roughly 2 to 3% exposure to emerging markets as a whole. That compares to MSCI All Country World at about 12%. Average institutional global fund had about a 5% exposure. So that also means, combine that with the fact that people came into this year, the end of that last year, with a lot of uncertainty and a lot of concentration. We all know what has worked, and people had a lot of profits on their books, but there were a bunch of question marks. US fiscal policy, US monetary policy, US politics, fiscal and broad government institutions, geopolitics, and much, much more. Not to mention the dollar had started to turn. And that changing of the dollar obviously came a lot with the kind of sentiment in terms of US monetary policy and the momentum for a dovish Fed. But it also came with a broad sentiment and perspective from the White House saying we are very comfortable with a weaker dollar because of all the economic changes we're making. This will keep us competitive. So historically, that's the biggest driver for emerging markets. 1% weaker move of the DXY, the Bloomberg Dollar Index, emerging market equities have historically rallied 3.5%. Direct inverse relationship over the past 27 years. So I think that's quite powerful. Why is that? Emerging markets have always sort of promised you the story of the future, natural resources, demographics, a lot of great things going for them. But they've had relatively shallow capital markets. So fund that future growth by coming to Europe, coming to the US, levering yourself up in hard currencies. And that means when the dollar gets stronger, your balance sheet expands, net interest expenses go up, and you start seeing negative earnings revisions. But when the dollar weakens, that exact opposite happens, and that can be very positive for the asset class. And I think it's probably your best hedge and best sort of diversifier in a weaker dollar environment. In terms of broad ingredients, what else sort of has to go right for a longer emerging market cycle? Discuss positioning, discuss the weaker dollar. Kind of that weaker dollar kind of goes in line with US monetary policy. Over the past US 7 rate cutting cycles, emerging market equities have outperformed small caps, which I think is fascinating. The S&P, the NASDAQ, and MSCI All Country World following the last cut in both a 6-month period and a 12-month period by double digits. So I think that's quite remarkable, considering I don't think we've gotten to the last cut yet. But as Chairman Powell said this morning or yesterday, whatever time zone we're in, because I got here 2 days ago, we don't know. We have to be humble. We're not sure exactly what's going on, but most Fed officials kind of just kept things on hold. One wanted to cut, but I think everyone has showed a lot of humility saying, normally these sort of shocks of supply aren't long-term. We're not sure how much it's going to read through to inflation, not sure that this is sustainable. We have to keep our eye on the data. So we still think the Fed should be relatively dovish, especially with the new Fed chair coming in a few months. So dollar positioning, incremental growth divergence. For the first time in a long time, you're seeing incremental growth favoring emerging international markets compared to the US, and that's streaming through to EPS revisions as well. Renewed strength in China, coming from the US. China's been a four-letter word. It's been uninvestable, untouchable for the past 5 years or so. We are seeing allocators start to come around, a lot having to do with the consumption trade, a lot having to do with technology, but a lot kind of having to do with finding an alignment of interests with the CCP, seeing the CCP kind of pivot towards what we've seen in Japan and Korea with these value up programs, finally starting to care a little bit about capital markets, and just kind of seeing some renewed stability and interest in China, which is such a big part of emerging markets. So as a whole, we think emerging markets has quite an attractive backdrop, especially with the 45% multiple discount to the S&P. Now, within it, we can kind of discuss what has worked, but I think India should be a very interesting place to start, specifically as a potential standalone allocation. This is kind of a summary chart of what I'm going to speak about over the next 10 to 15 minutes, but we'll go into details on the first 3 bullets. But I think that bottom bullet is quite interesting, that India is not your typical cyclical emerging market country. Its beta to the asset class is about 0.5. Its volatility has been extremely low over the past 7 to 10 years. Actually, over the past 7 years, if you look at returns over volatility in terms of its risk-adjusted returns, it has actually matched the S&P and the NASDAQ. So from sort of just a numeric risk profile, I think India it differentiates itself from what most people expect out of kind of volatile, scary emerging market countries. It's shown fiscal consolidation. Its fiscal deficit is now only about 4% of GDP. Its current account deficit is less than 2% of GDP. So, that sort of association with the Fragile Five and all that kind of volatile, irresponsible governance that we remembered from taper tantrum around 2013, I think that has diminished greatly. So big picture, we'll kind of go through these points. India is, I think, your best demographic story in the world. It is a key beneficiary from supply chain diversification out of China. After the recent year and a half, and this might be controversial, I actually think it's inexpensive. The biggest pushback on India has always historically been that multiples are way too high, but they have pulled back a significant amount, and relative to growth and profitability, I think they actually look quite attractive. And then governance, because emerging markets, you can always tell a really compelling story for EM, but we always get in our own way. I'm half Brazilian. We've always boasted Brazil as the story of tomorrow, the story of the future, but our politicians continuously get in the way, and it's become it's always a challenging problem. The BJP and Modi have now into their 3rd term. Over the past 10 years, we've seen over 250 million people move into the middle class. Income per capita has just kind of eclipsed that pivotal point of the J-curve. I have over $2,500 per person, and we see incremental consumer spending really picking up. And I think the economy is really running on all cylinders. Caveat, we import 90% of oil we import 90% of oil in general, and 44% of that comes through the Straits of Hormuz. So right now, obviously a delicate time to speak about India. But depending on your views, guys, is this going to last forever, or is the market price this in? Because if you think this rolls off and we start reaching towards normalization, any sign of peace, any sign of normalization, that market's going to move way before oil prices drop back to $70 a barrel. So this could be a really interesting time to just leg into, could be an active manager, could be a passive ETF, you could be stock picking. I'm not here to sell our strategy. The ticker is NDIA. It's the only passive strategy in Australia. But I think people should keep their eyes on it. So jumping in, demographics. India, largest population in the world, largest youth population in the world, and importantly, that youth population is very well educated. The literacy rate above 90% that I don't think a lot of people give India credit for. In addition to that, the education system is quite strong, not only in terms of teaching various languages, including English, but also a key focus on sciences, technologies, engineering, and maths. And I think, combine that young population, that educated population, and it being a very well-connected population because of a lot of the government spending and reforms that we've seen over the past decade, it positions itself very, very well for the future. And I'll get into a bit of that connectivity in a few slides. But this chart on the bottom right, I think, is very important. Because it's not just about being big. It is about the government reforms and GDP growth, which is growing above 7.5%, actually leading people in to move up in regards to the economic pyramid. So orange means basically now or last couple of years, dark blue, medium term, light blue, long term. And you can see on the left that's wealthy and middle class. On the right, those are the lower ends of the economic pyramid. If you're moving on the left from bottom to high, that means the country is getting richer. And the categories in terms of who's aspirational or who's living in poverty, that should be decreasing dramatically. And I think that should be quite important for the whole Indian economic growth story. In addition to that, it is that we see very low penetration levels. Whether that be connectivity, which is really catching up significantly, physical infrastructure, but in terms of what's actually going to move the economy, I think it's credit to GDP, I think it's mortgage rates. That's where we're really seeing the needle beginning to move. And that needle is beginning to move because of economic inclusion that we're seeing through some key reforms that have come through the government over the past 5 years. Basically taking the informal economy and putting them into what we consider the formal economy. When I say formal economy, it means that you're tracked, it means that you're paying taxes, it means that there is an efficiency of tax collection that improves revenues, which means the government can spend money while also committing to fiscal consolidation. So that means risk premiums should come down, interest rates should be low, your cost of capital, whatever you're discounting future cash flows, should be quite low because people are seeing that the risk associated with this country continues to diminish. So I keep referring to reforms and how those are good things. Let's kind of get into the key ones that I think are important. I guess we can start with, from an investor perspective, taxes have gotten a lot easier in terms of going from a 29-state different tax system to 3 or 4 different tax codes, implementing a GST. But more importantly, from our perspectives, they have reduced the corporate tax rates by about 400 or 500 basis points over the past few years. And I think that is quite dramatic. So, okay, put on your macro hats a little bit, and now you are thinking, all right, you're reducing taxes, people are paying less, and you're spending physical infrastructure, digital infrastructure. I'm getting a little nervous because when emerging markets spend too much, they tend to get into trouble. The amazing thing about this is that they're doing so while actually consolidating their fiscal deficit, because some of these reforms have pointed towards the efficiency of tax collection. So the digital economy, they've taken 80% of paper currency out of the economy. So if you want to buy a candy bar or take a taxi ride, whatever you might want to do, you are paying for it digitally, which means that everyone has to have a digital account. To have a digital account, you have to be connected to a bank account, and to have a bank account, the government is tracking you. So combine that with transaction taxes, income taxes, whatever it might be. These are little, a lot of this country is quite poor, little bits of collections, but they add up with 1.5 billion people. The other part of that in terms of formalization is the Aadhaar program, which is basically a digital identification program, which 92+% of the population is now signed up for. Now with the Aadhaar program, with just a thumbprint or a retina scan, you can send your children to public school, you can pay taxes, most importantly, but you can also sign up for a bank account, which connects with that digital connectivity, digital payment program as well. With that, that means, historically, to open a bank account, you needed to show 6 months of utility bills, a proof of an official residence, who you're married to, employment, official employment, things of that nature. Now you're really just doing so with a thumbprint, and I think that can be quite powerful. So kind of combine those two. I think those are 2 key reform programs, but with corporate tax cuts, with the efficiency of efficiency programs, cutting red tape, reducing bureaucracy, pushing forward with the Make in India program, which we'll get to in a little bit, but really being the key beneficiary of supply chain diversification out of China. All of that is really helping India's story and setting a very positive, responsible backdrop for future growth. Did I go too forward? Yeah. Excuse me. I'm pressing the wrong button, guys. There we go. Sorry. Toby, yeah, thank you. Okay. Let me go into someone else's slides. All right. Thank you. Okay. Did I lose everyone? Okay, I hope not. Okay, so I mentioned beneficiary of global supply chain diversification. China is changing. This isn't just about tariffs. This isn't just about US and European or Australian companies getting nervous about China and saying, well, I don't want to have full concentration there. I want to move some of my production, steps of production to Vietnam or Indonesia or other places. This is actually about China wanting to change. China doesn't want to be the factory of the world anymore. It doesn't want to be dependent on Western demand. It doesn't want to be subject to tariffs or slaps on the wrist or whatever it might be. Counterintuitively, the US has sort of set an economic blueprint for where China wants to be. 65–70% of GDP growth in the US comes from domestic consumption. In China, that's still 35–40%. So they really want to shift this massive economic engine to a place where they are self-sufficient, dependent on domestic consumption growth. And that's the whole idea behind common prosperity and wanting to double the middle class by 2035. So it's domestic consumption and it's self-reliance on technology. And that leaves a lot of other opportunities for other countries to pick up the work that China's been doing and been very successful with for the past 3 decades. And India is saying, yes, please, we would love to do that. We will offer tax subsidies to do that. We will be very friendly, we'll create a very friendly market environment to attract jobs, to attract foreign direct investment. And we've seen the likes of Boeing, Tesla, Microsoft, Google, and various others set up Asian headquarters in India over the past 3 to 5 years. I think importantly, a lot of people don't realize 25% of iPhones are now manufactured in India. And that's just an anecdote, but there are a lot of others like that. And I think we're going to continue moving in that direction. So moving in the right direction there as well. There we go. Okay. This is sort of what I was pointing to earlier. So India definitely spending in terms of digital infrastructure, 4 and 5G speed into the most remote parts and provinces throughout the country, public-private partnerships with the Reliance Industries to create a $10 smartphone. So now really even the most poor segments of this population are connected and paying digitally, following apps, whatever, growing up in a digitally native environment, which is quite powerful. But the physical infrastructure build out is coming there as well. That's coming in terms of ports, highways, airports, more increasing infrastructure in tier 2 and tier 3 cities. So I love the contradiction of these two charts, that CapEx is actually picking up on one side, but your fiscal deficit's coming down on the other, which points to the kind of responsible fiscal management that we've been seeing in terms of balancing your costs with your revenues. Digital revolution. I mean, there's so many stats we can point to here, but I think it's interesting to see that there are 123,000 startups, 127 unicorns within India, combining this young population with the connectivity across the population, not just in terms of speed, but with actual access to hardware. This is quite remarkable and sets up India is not just going to be a manufacturing base. We think it's going to be a tech hub and a key area for emerging market innovation going forward as well. Monetary policy. So we talked about fiscal policy. Now we're speaking about monetary policy. Inflation rate, the target rate's 4%. Inflation rates are closer to 2.8, 3% right now. They were one of the first central banks to hike rates coming out of COVID very prudently, and then one of the first to begin cutting as well. So we have positive real rates, and it's I think 5.25% right now. Nothing extremely, this isn't a very strong carry trade by any means, but you've got room if oil comes back down to kind of stay on hold or maybe 1 or 2 cuts. Central bank governor has been quite dovish, and we're coming out of a bit of a cutting cycle as well. So I think it's kind of interesting to look at over the past year. India was a laggard, a market laggard overall, compared to emerging markets. And the big reason behind that was because of this stalemate between Trump and Modi and a potential 50% tariff, which we eventually ended at 19%, and then everything was off the table at the Supreme Court, and now we're at 15% for the next 150 days. I don't know what's coming next, but I think we're moving in the right direction. But in the background, everything was going really well for India. Monetary policy cuts, foot on the gas in terms of fiscal spending, fiscal consolidation at the same time. Current account deficit was less than 3% of GDP. Gold prices skyrocketing. 22% of average household savings in India lie in gold. So that's amazing for consumer confidence and middle class consumption. And then, of course, before all this happened, energy prices were quite subdued. India imports 90% of its energy needs. Okay, so I think that this isn't in the slides because I submitted this on February 24th, but we should talk about the energy situation. If this lasts for a long time, this is going to put pressure on India. Modi's a master negotiator, though. He's been doing a lot better than I initially expected through this situation. We've had 3 ships go through the Straits of Hormuz with LNG and LPG over the past 2 days. He's in direct contact, or his people are in direct contact with Tehran. So one of the few countries actually moving energy supplies through the Straits. He's also in direct contact with Trump. He's gotten a 30-day window to buy discounted Russian oil. And then before that, before he initially had said, I'm not going to buy oil from Russia anymore, they had been stockpiling discounted reserves, discounts of $30 a barrel at some points for the past 2 years. So there is a buffer in terms of crude. In terms of LNG and LPG, it's much, much tighter, but that's what they're working on to get through the Straits right now. But I'm trying to say, the headline probably isn't as bad as it sounds, but if it lasts, it could get worse. So that's your view. Let's see what happens. I know you've got next panel is the view from Washington, so hopefully that educates us all in terms of where we're going. But if it's improving, I really think India's a buy. So kind of big picture, GDP equals private consumption plus private investment plus government spending plus exports minus imports. Every emerging market economy grows kind of based off of 1 or 2 of these different pillars. India checks all the boxes. Government spending, we spoke about. Private consumption, this middle class is booming. Foreign direct investment, I told you about all these different international companies are setting up centers of excellence and Asian headquarters within Asia. FDI is running off the charts. Also, just in terms of equities and fixed income, the IPO market is really flying, and the fixed income market was just included into the major indexes. And then exports minus imports. In the background, up until we had this almost trade deal with the US, we saw a free trade deal with Europe, very powerful. We saw one with the UK. We saw one with New Zealand. We saw one with various countries within the Middle East. So Modi wasn't lazy, kind of sitting on his hands waiting for a deal with the US last year. He was expanding free trade globally. And now I think we're finally got to a good place with the US as well. So that's it, kind of big picture. Do I have 2 seconds just to talk about valuations? Okay, because I'm sure that'll be a question. Nifty 50 is currently at about 15 times earnings. Historical average over the past 7 years, I believe, is about 18 times. Trading now 1 standard deviation below its historical average. That's very rare within India. India is always in line with historical averages, at a premium to emerging markets, sometimes in line with the S&P, which is closer to 20 times. So I think this is a rare opportunity to buy India at a discount. But forget that. Say you don't want to compare it to historical averages, don't want to compare it to the S&P, not apples to apples. Your way of looking at it is it looks expensive compared to the rest of EM. I'd rather buy South America or China or anything else that looks cheaper, just on a multiple basis. Take a step back. India's GDP growth levels last year was 7.5%. Next 5-year CAGR should be 6.5 to 7%. That type of GDP growth makes EPS growth quite easy to achieve between 15 and 20%. Broad emerging market GDP growth is about 3%, with earnings growth maybe 10 to 12%. So from a PEG ratio perspective, India looks very attractive. What I think is more important is that broad emerging market profitability in terms of ROEs is about 12%. So I don't know how you guys, what you put into your CAPM models, but your cost of capital in EM is probably going to be 10 to 12% as well. So broadly speaking, EM's profitability sometimes doesn't even meet its cost of capital. So this might be like a dilutive backdrop as a whole. India, on the other hand, I mentioned rates are coming down. I mentioned governance is improving. I mentioned capital markets are deepening. Its key rate is 5.25%. Brazil's key rate's 15%. While ROE's profitability in India is 16 to 18%. So all that growth that I mentioned, that 7.5% GDP growth, your 15 to 20% EPS growth, you're reinvesting that into an accretive backdrop of ROEs, call it 17% above your cost of capital in mid-high single digits. So with that, I really like India. Buy it on a dip.
Now there's time for questions. So
I'm going to play devil's advocate with you for a moment.
Come again?
I'm going to play devil's advocate with you for a moment.
Do you have to?
And I do, because there's one little niggle. AI disruption.
Yeah.
8% of India's GDP relates to software developer outsourcing. Is there a job for them anymore would be a question, but a lot of the India outsourcing is maintenance, lower value development, cheaper labour arbitrage. So with that backdrop and that coming at them quickly, is there a cockroach in the context of India?
Sure. If I'm a mid-cap, small-cap IT service provider that's basically a call center, you're going to have to kind of reinvent yourself. Those jobs they've been going away for the past 5 years. Before AI, you've had chatbots, you've had other things. Now they're only improving. So very good point. I don't know. Like, I mean, I didn't think AI would create this big software sell down we saw a few months ago. 4 years ago, I didn't know AI was going to be such a big deal in the first place. Things change, but I do think India as a backdrop, if technology continues to improve, and we're going to forget about AI in a second, we're going to start talking about quantum computing next. India's youth, India's connectivity, the fact that global tech companies are focusing on India, Anthropic, OpenAI, Google, Meta, they're all rolling out their AI programs completely for free, or sometimes in some cases at very, very subsidized levels in India, because they know this is going to be a huge base of innovation, and they are hiring people within India and setting up bases within India for implementation. So I was on earnings calls for TCS and Infosys over the past few weeks, and they're, of course you're going to be positive on an earnings call, but they are pointing to revenue generation from AI implementation for their multinational clients. So this is sort of like a new segment of revenue generation for them. They're not talking about the business that they've lost at this point. I hope that this can outweigh the negative, because there will be, everyone's getting more efficient. But you're still going to need people, in my very humble opinion, you're going to need people to implement these technologies, build agents, walk stupid portfolio managers like me through how do I build this so it can build a model for me and things of that nature. You're going to need consultants, and India is going to be technologically advanced, and they're going to be cheaper than me hiring somebody, in Connecticut to do it. So,
other questions? Yeah, Richard.
Could you give us a rough breakdown of the index and the extent to which you've got massive concentration risk?
Chad, can you help me? Because on the index, I'm so sorry. So I manage a global emerging market equity portfolio that's focused on MSCI. Our Australia product is probably better from an India perspective, because it's just the Nifty 50. These are the best and brightest companies within it. Can you help me from a Nifty 50?
No, it's broadly diversified across the 50 largest companies on the National Stock Exchange there.
I know it's heavy financials.
Yeah, some financials, some industrials. Those predominant companies in India, the household names, the stock standard names are well represented. But we can certainly provide look-throughs to clients if you had any other questions in terms of concentration on a company basis, sector basis, and so on.
Thanks to Claude, 33% financial services, 13% IT software, 11% oil and gas, 9% consumer goods.
Thank you.
Yeah.
Go Claude. Who needs an analyst? But how good is that? The 33% financials, I think, is especially good, because we're talking about headwinds and tailwinds from AI. Indian banks and financial services are going to have extreme tailwinds from AI. 67% of OPEX from Indian banks come from people working at physical branches. When you think about cost of income and efficiency ratios, they are going to be downsizing branches, they're going to be closing branches, everything is becoming digital. So that means you're I don't know if you're necessarily firing people, but you're not rehiring people. Your overall headcount and cost base is going to come down, while at the same time, this technology is going to make asset quality decisions way more efficient, way better, for lack of better words. And I think you are going to see improved asset quality, more loan growth, lower costs, and overall massive pickups in earnings, which is going to lead to ROEs moving from, if they're on average at 15% now, I think Indian bank ROEs could be sustainably at 20%.
One more.
One last.
Can I also say, is there a natural successor to President Modi?
No, and I think that's, and if anyone here has a better view, I don't think that there is, but the BJP, his party, I think this is the best thing that he's done. It used to, first term and a half, it was just a Modi show. And there are a lot of good people within the party now, and he is dominating on state elections, major state elections that the BJP has never won, and far more regional kind of outlets of the country. So it's not just like a Modi top-down national story anymore. I think he's got it's more of a BJP story, similar to Greece. It's not like one person. A lot of people can't name who the prime minister of Greece is, but most people know the New Democracy is a fantastic, powerful party implementing economic reforms. I think India's kind of taking that same path.
India doesn't have a kind of a social security system or anything like the Western countries have. And if you're going to have this elimination of jobs in many places, how is that going to impact on what's going on there?
Yeah, I think it's going to have to change. It's going to have to change, especially if you have to keep this voter base happy. You need to keep your social safety net improving day by day. I don't think it comes through bazooka. Funny enough, I think India's kind of learned from China. China's a communist country. You'd think they have an amazing social safety net, but they just don't. But they kind of improve, and they show little to do just enough to keep the population happy, so the CCP doesn't get thrown out. I think India's probably going to take a similar path because they want to be fiscally responsible. But over time, if you see a population become unsettled, you're going to have to appease them with spending. So it's something to keep an eye on. I think India's kind of interesting like that. India sort of waits for demand before they implement supply from a government perspective. Like in China, you saw over the past few decades all these big cities being built out before there were actually people who wanted to buy apartments. It was great. They had the power to do so. These are very clean, beautiful cities. India kind of waits for a lot of these sort of informal towns to build up and to kind of show the actual demand of housing needs. This is just one example, before the government kind of comes in and will create subsidized housing and things of that nature. And I think waiting for demand before you implement supply is actually a smart thing from a planning perspective, because you can kind of assess how profitable that project's going to be. It's probably a key reason, very broadly speaking, why India's profitability levels are 700 basis points above China's.
Wonderful. I got that. Okay.
Thank you. The questions are getting harder. Bye.
Malcom.